We are now in the fourth quarter of 2025 and the S&P 500 has performed admirably. I already discussed some of the worst performers of the year last week, but now I want to turn my attention to the best performers in the S&P 500 for 2025. And there are some surprising names on the list. There are some expected businesses too that have kept their returns going strong. So it is these 5 big winners so far of 2025 that I want to review today and understand why they have won so big this year. Welcome to The Quality Investor. I'm not going to list off the 5 top returners of 2025, but instead I want to look at what I believe are notable stocks as well as some unexpected stocks that wouldn't strike the investor crowd as hot commodities. Yet, hot they are. One stock, though, has had truly breathtaking returns, but I would argue their fundamentals might not justify its valuation. But the investment community surrounding this stock that's engaging on social media is incredibly devoted to it. So while these are hot commodities, it remains to be seen if they can keep their torrid pace going for the rest of the year and beyond. The 5 winners of the S&P 500 that we're discussing today are Robinhood Markets, Western Digital, AppLovin, Intel, and Palantir. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. So as of this recording, here is a breakdown of the year-to-date returns for the 5 businesses we're discussing today. Robinhood Markets has been on fire, a 304.91% year-to-date return. They're up 489% on a one-year basis. Their share price sits at $150.87, right around their 52-week high. So just incredible year so far for Robinhood Markets. And this is followed by one of the more surprising businesses on this list, and actually the second best performing business in the S&P 500 in 2025, and that's Western Digital. Western Digital is a technology company, but they specialize in hardware, and specifically hardware for data storage, which will become important in a second here. Currently trading at $121.18 with a year-to-date return of 169%. And Palantir, of course, is the business that has, I don't want to say has a cult-like following in social media, but definitely a very devoted following. They have returned 142.7% year to date, up 342.8% on a one-year basis. Like Robinhood, they benefited from their addition to the S&P 500 this year, but this business has been shooting up like a rocket ship. AppLovin, another new addition in 2025 to the S&P 500, has a 94.5% return year to date and a 338.8% return on a one-year basis. This is a business that I considered buying about a year ago and decided to pass, and I slightly regret that decision. And another surprising business on this list, which is Intel. Intel has been mired in a downswing in recent years, seemingly left behind in the chips arms race that AI has created within the industry over the last few years. But year to date, they're up 86.7%. But you can see on that 5-year basis here, annually, they are still losing 7% per year. So we're going to dive into why Intel has seemingly had this miraculous turnaround. But look at the PE ratios for each of these businesses. Robinhood Markets sits at 76.6, which is high, but could be justified for a business growing the way they're growing. Western Digital with the smallest PE ratio on this list at 23.6, but Palantir has that bubble type PE ratio at 611.9. AppLovin, another business with a software PE ratio here of 89.4, but they're also growing like leaps and bounds. And then Intel, as you can see here, has no PE ratio, meaning they're not even profitable at this point. So let's dig into Robinhood Markets first. Robinhood has been growing like leaps and bounds since its IPO. You can see the revenue on a one-year basis is up 58.2%. On an annual 5-year basis here, they've grown their revenue by 60% per year. And you can see in fiscal year 2024, they became profitable. And it looks like they're never looking back from that. Now, Robinhood has become a very popular trading app amongst the Gen Z and millennial cohort because of the fact that aside from traditional equities, they're really big into the crypto markets. In their most recent quarter ended, they saw their revenue jump 45% year over year to close to $1 billion in one quarter. And they're also starting to push gross margins over 90%. So an incredibly profitable business along with their staggering growth. And on that crypto point, they saw Q2 crypto revenues soaring 98% to 160 million. And the market is certainly perceiving a lot of positive tailwinds for the crypto segments in general, as the Trump administration is really pushing to legitimize crypto as a mainstream investment, and we see a lot of Wall Street funds starting to buy into that as well. And Robinhood certainly benefits from that first mover advantage in crypto, as they've always had crypto assets on their app, and they have upcoming features like staking and lending for crypto as well. Regarding funded accounts, Robinhood added 2.3 million funded accounts in Q2 alone. And this is certainly driven by that cohort I mentioned, Gen Z and Millennial. But also notably, they're expanding into the prediction markets aimed at competing with Kalshi and Polymarket. So Robinhood certainly has a lot of vectors of growth going on right now, and it certainly seems like that 76.6 PE ratio, at least in this case, is very justified, although Robinhood's still an early growth company. And PE ratios really don't mean a lot in this instance. They have a cash pile that's growing, they've managed their debt very well. This is a very well-rounded business, and they were included earlier this year, and they were added to the S&P 500 in September, which was another booster to an already great year. Reason being is once they get added to the index, the myriad of ETFs that exist out there that are linked to the S&P 500, they have to buy that stock now in order to add it to their offering. So they just get that boost there by getting into the S&P 500 through sheer buying quantity. So Robinhood certainly has a bright future ahead of it. This is certainly a business worth looking into later. It's a little bit early for me. I feel like, though, I'm not worried about being late on businesses. I do want to see a history of compounding. I don't doubt that it will continue to grow, but a lot of indicators point to Robinhood as being a very good investment for investors, not only in the short term, but in the long term. Western Digital is one of the more surprising businesses on this list. I already mentioned they have returned an amazing 169% year to date, but this is a business that really doesn't get a lot of social media discussion. Western Digital is a business that makes hardware, and specifically they make data storage solutions. So why has a business like this boomed in 2025? Well, it has ridden the coattails of the general AI boom. The explosive growth of AI workloads, particularly for things like large language models and agentic AI, it's created this massive demand for high capacity, cost effective storage, specifically data storage. And all the major hyperscalers right now, AWS, Google Cloud, Microsoft Azure, part of their massive CapEx spending is going to build out this storage. And while they need suppliers for this, and that's where Western Digital comes in. Western Digital, of course, is among the leaders of hard disk drives as well as flash, so they've benefited extremely well from this storage. And we can see that here with that 50% year-over-year growth in revenue. Revenues at 9.5 billion, up from 6.3 billion in the prior year. And you can see that massive drop in revenue from fiscal year 2022 to 2023. This is a business that's been very inconsistent historically here. You can see that both in their operating cash, their free cash flow, their market capitalization. This was never a big high growth business to begin with. And they're really in a industry, hardware, that's relatively commoditized. I generally avoid hardware type stocks just because of the commodification of them. I view it as an industry with very low barriers to entry. A lot of different players can come and replicate that sort of hardware relatively quickly compared to some other types of industries. But nonetheless, Western Digital is benefiting from all of this, and one of the areas they've benefited a lot is they've hiked their prices across their entire HDD portfolio. And so basically they're capitalizing on the tight supply of AI data demand constraints. So while Western Digital is certainly benefiting right now from the AI arms race, as well as projected 20 to 30% revenue growth heading into fiscal year 2026, there are still some risks here, especially since their revenue growth seems to depend heavily on AI CapEx spending cycles. And those can be pretty volatile, and we'll see if they continue at the pace they're going at right now, basically at a torrid pace, trying to project all this supposed demand out there. Well, we'll see if that demand comes to fruition over the next couple of years. And I do think they're in a relatively commoditized industry, like I said, but there's still a lot of tailwinds for Western Digital as well. Data is going to continue to proliferate throughout the tech industry as it needs to train all of its AI models on data. So the data needs are just going to grow as we move forward here in this AI boom. AppLovin is a business I mentioned earlier where I wish I had bought it about a year ago when I was looking at it. I did not pull the trigger. I spent my money elsewhere. I don't remember exactly what stock I bought at the time. But as you can see, I've missed out on a year-to-date return so far far, up 94% for AppLovin. That said, this is another amazing growth story for 2025. Their revenue growth on a one-year basis here is at 43%. On a trailing 12 basis, they're up again at 5.3 billion compared to 4.7 billion in their fiscal year 2024. And they seem poised to become a compounding machine. You can see that here in their free cash flow. And they really don't have a lot of stock-based compensation as well, also less than 10%. So they're doing a good job of managing that as well as growing that free cash flow. This is a business that fits the bill for everything I like. It's very capital light, high margin. AppLovin is basically an application technology platform. And what they do is they specialize in AI-powered advertising where they try to match an advertiser demand with the publisher supply through auctions at this vast scale. And of course, it's this AI optimization tool that has seen massive growth. It has enabled their developers to slash user acquisition costs. It's boosting their profitability through these hyper-targeted campaigns. And ad spend on the platform has quadrupled since 2023. So not only are they growing rapidly right now, it seems like growth is accelerating. In their Q2 earnings, their revenue surged by 77% year over year, and their margins are also exploding. Their gross margins at 75% at the end of their most recent fiscal year. Their trailing 12 margins now at 81%. Same with their operating margin, 39.7%, and on a trailing 12 basis, sitting at 55.6%. And the story is the same for the free cash flow margin. So this is a business that's expanding margins. They're growing rapidly. Their ROIC is also incredible at 89.4% ROIC on a trailing 12 basis. So there's a lot to like here, but of course they surged in share price. They're trading at $629.70 as of this recording. So US mobile ad spend has hit $228 billion in 2025, and AI tools are responsible for 69% of these operations. AppLovin's focus on performance-based in-app ads taps into e-commerce's embrace of mobile as a core channel, and this bypasses the traditional display and social limits. So as e-commerce continues to grow here and mobile app platforms also continue to grow, AppLovin's going to be a direct beneficiary of this down the road. So their growth is far from over. Intel has staged an incredible turnaround in 2025. Their return, 86.7% year to date. On a one-year basis, they're up 60.5%. Certainly nothing short of amazing. However, if you invested in Intel about 10 years ago, you would have only grown your money at about 1.4% per year. So there's still a lot of work to do for Intel. The question with Intel, though, is this turnaround more of a mirage? Well, let's take a look. So you can see that even before their revenue just sort of fell off, they were a very slow growing company. See, Intel used to be one of the innovators in the chip space, but what Intel suffered from greatly in the last few years was that they were trying to be a chip maker that was not just designing the chips, but also manufacturing the chips. And that marriage has proven to be very inefficient here in the modern age. NVIDIA, they just design the chips. TSM manufactures them. So Intel has been struggling with massive CapEx spending that really has not returned anything on their capital, just due to the fact they haven't really figured out how to make this work in the modern age. As you can see here, that the free cash flow has simply fallen off a cliff, and they're still not profitable. They lost money in fiscal year 2024, and they're losing even more money trailing 12 basis right now in fiscal year 2025. So the rally that Intel has experienced in 2025 really stems from government backing of the business. Trump's administration acquired a 10% stake in Intel with a $9 billion infusion via the CHIPS Act, and that was part of a broader $16 billion commitment to reshoring or onshoring chip manufacturing. So Intel hasn't given up quite yet on fabricating chips as a part of their business model, but what they're doing is leveraging the change in US policy to start building more of these chips on American soil. So much of this rally is really based on expectations now, certainly not on fundamental earnings. What also is helping Intel is that this capital, it's also shielding them from the foreign competition, especially from TSM, because there's potential tariffs on imports from TSM. And another boom for Intel here was a September deal which saw NVIDIA invest $5 billion in Intel common stock and commit to co-developing NVLink capable x86 CPUs for AI servers, positioning Intel's Granite Rapids Xeon 6 as the reference design for NVIDIA's DGX B300 systems. So Intel has been trying to get away from that legacy CPU moniker, and this is essential to try to reposition themselves as an AI enabler. And of course, everyone wants to get into AI now. That's what's unlocking all the gains in the market. Intel, smartly seeing the writing on the wall, is making moves to position himself that way. Intel's also doing the standard cost cutting, restructuring systems and operations to reduce the bureaucratic bloat that has slowed down the company's innovation over the years. But all in all, a lot of this rally is really built around expectations going forward. Certainly not based on anything real that Intel's delivered yet, but with some of these investments infused into the business from players such as NVIDIA and of course US government backing, it does seem like Intel's gaining real momentum here. We'll see if they can actually execute on any of these plans and truly turn it around and turn these investments into actual earnings. Palantir, a business that sparks a lot of polarization when it comes to YouTube and social media engagement. Frankly, I have not commented yet on Palantir on this channel, and one of the reasons I haven't is, to be fully transparent, I don't truly understand what Palantir does. But there's certainly a hot name in the world of AI. According to the basic description, they build software that assists in counterterrorism investigations and operations. They have 4 principal software platforms. One platform, Apollo, is this cloud-agnostic single control layer that coordinates ongoing delivery of new features. A second platform called Gotham enables users to identify patterns that are hidden deep within data sets. Their Foundry platform transforms the ways organizations operate by creating a central operating system for their data. And the Palantir Artificial Intelligence platform enables responsible artificial intelligence across the enterprise by using primary core components built to effectively activate large language models. And it's this last platform that has really been the game changer for Palantir. If you listen to any YouTube channels about Palantir or see anything on X, for example, it's always called the AI operating system. And their latest revenue for Q2 grew a staggering 93% year over year to $306 million. And it was 70% of total growth. And one advantage that this platform has is the way they monetize it. The pricing is based on consumption. So the more a user consumes, the more they pay. But Palantir's real bread and butter is in their government contracts. They have a $10 billion pipeline with the US Army right now. And they just secured a $795 million Department of Defense contract, a $619 million Army Vantage renewal, and they also have a landmark $1.5 billion UK Ministry of Defense partnership. So Palantir is really securing their future with these very high margin contracts that are also multi-year. And you can see now this has really fueled Palantir's growth. You can see very consistent revenue growth year over year. And on a 1 year basis here, the revenues grew nearly 30%. Their operating income has exploded. They're now profitable, which is very important. And they continue to compound free cash flow. And this is going to be important going forward. Very capital light business. They're stacking cash. So there's a lot of potential here for this business, but this 611.9 PE ratio leaves a lot to be desired. Consider that they have a $435 billion market cap. That makes them the 19th largest business in the S&P 500. And that's on a trailing 12 basis revenue of $3.4 billion. So a lot of Palantir's valuation comes from huge expectations. Now they're certainly delivering. This is unlike Intel, where Intel hasn't turned it around yet, at least on a results basis. But Palantir is delivering growing results here and clearly showing that they're becoming more profitable and returning more cash to investors. But they have a lot of growth to do to catch up to this 611.9 PE ratio. Palantir has also helped. They're another business along with AppLovin and Robinhood Markets that were included in the S&P 500 in 2025, so they got a nice bump there as well. But all in all, there's a lot of bright future ahead for Palantir, but again, this seems like a business that could be interesting to look at down the road. But at this share price, I feel like they need to come down quite a bit before even considering putting money into this business. Now, if you were in it early, what I think last year is trading in the 30s or something like that, I'm sure you're an incredibly happy investor today, but right now at $183, it's an extremely rich valuation. So that's a look at 5 businesses that have performed very well so far in 2025, and all of them seem poised to continue to generate outsized returns against the market at least. Maybe not what they've returned this year, but I do think all of these businesses will continue to beat the S&P 500 in general and be very good investments for investors going forward.
Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.